Today's episode of Wine and Dime is sponsored by Rooted Planning Group, a fee-only financial planning firm that believes life is about events, supported by your dollars and cents. And we want to help you achieve your goals. Hop on over to www.rootedpg.com to learn more about the services. Every week, it's my goal to share financial information that helps you in both your life and Financial Vineyard. We hope it takes you from your roots to the journey of your vines and the influences in the air that have helped craft your delicious life. Like wine, life and finances have different palates that should be celebrated and not judged.
Hi, Wine and Dime listeners. Amy Irvine here. As you recall, we are doing a series this month on economic terms and understanding economic terms, because every month I try to do a webinar where I talk about how the sort of state of the economy and stock market. And it kind of stood out to me that, well, maybe not everybody is familiar with the terms like I am. They don't use them every day in their lives. So maybe I should do a series on terms and terminology that are supportive of those webinars that I do and kind of give some definitions. So if you missed last week's, feel free to go back. Last week, we talked about the importance of understanding the Fed funds rate, how it affects you, the different terms around rates just in general. And this week, we're going to be talking about understanding economic indicators. But of course, before we go there, I want to make mention I'm back to the U.S. This particular podcast recording. As you may recall, I mentioned that I was going to be going to Scotland sometime in 2024. And so I was trying to explore some wineries over in Scotland, but the lure of the Oregon coast once again, or the Oregon Willamette Valley, once again sparked my eye as I enjoyed a very nice Pinot Noir Rosé of Pinot Noir from Airlie wines. I know I've mentioned them before. I happened to find one in my wine cellar, pulled it out. Oh, so yummy. So I just wanted to give a shout out to them once again, because they were one of my favorites when we were out in that area. And they certainly helped get me through the tax season of the worst, I should say, of tax season of 2023. So Airlie Winery, if you're interested in their rows of Pinot Noir, very yummy. If you like that kind of spicy rosé. Very refreshing, though. All right, so let's dig into understanding economic indicators. There are sort of two indicators that I usually talk about when I'm doing the webinar that I mentioned, and it's usually about 10 minutes that I try, 10 to 15 minutes that I try to keep it to. One of the topics that I dig into is economic indicators and what's called Institute of Supply, or ISM, economic activity indices. Economic indicators that I like to follow are the leading economic indicators, or I'll refer to them as LEI, and they tend to be year-over-year percentage changes, so they are a trend for sure. The index includes things like average weekly hours in manufacturing, because the more manufacturing that's taking place, the more our economy is growing, or the less manufacturing, the slower our economy is. Also, the average weekly initial claims for unemployment insurance. That's certainly an indicator of the number of people that are being laid off or hired. Manufacturers' new orders for consumer goods and materials. That's a big one. A piece of that leading economic indicator is that ISM index for new orders that I mentioned. I also follow a little bit more closely. And then manufacturers' new orders for non-defense capital goods. So it's excluding like aircraft orders. I look also at building permits for new private housing units. You've seen me, if you've seen any of those, where I talk about new build contracts, not just existing home contracts, but contracts for new build. And then things like the S&P 500 in leading credit index, the interest rate spreads, that interest rate spread, then meaning the difference between the 10-year treasury bond less the Fed funds rate. So, we are looking at those kinds of things and one other thing I guess that's included in that is the average consumer expectations for business conditions. So that's actually that's like consumer sentiment, which I'm going to get into a lot of those terms later throughout this series, but those are all things that the National Bureau of Economic Research looks at. So they dig into all of those numbers, and then they come up with what's considered sort of that leading economic index. And when the index turns negative, when you see that index or the leading economic indicators turn negative, that is a very good sign that we're likely headed for a recession. And usually, say always, because there's averages that exist, right? And averages exist because of highs and lows. But typically, when we see that when the LEI turns negative, that's a few months ahead of an actual recession as the economy decelerates. Now, right now, as I record this, it is currently negative by about 6.5%. So it could go further, but there is a pretty good indicator that we are either in or we are headed for a recession or slowdown within the economy. So again, there's a lot of things that are taken into consideration when we're talking about that leading economic indicator that are combined to reflect that kind of negative figure that might be coming out of our economy. So when they talk about, are we in a recession or are we not in a recession, sometimes that indicator, because remember, typically a recession isn't declared until 2 consecutive quarters of overall slowing activity. So if something starts to turn negative, that may be 6 to 9 months, ahead of when it's actually declared that we are in a recession. So that's a really important number for me to keep an eye on to see where we're headed economically. Now, another podcast that you're going to hear that I'm going to dig into is just because we are in a recession doesn't mean that that the stock market necessarily is in lockstep with the slowing economy. Because remember, the stock market, remember I said the S&P 500 is an index. Well, it can be an index on the way down and it can be an index on the way up too. So they don't always work in lockstep. So I think it's important to understand that. And one of the slides that I show is the various leading economic indicators. It dates actually back to 1970 is what I show, and how negative those indicators got before or during an actual recession. And I think that's probably an interesting point. So come to the webinars or listen to our videos after we record the webinar to get more information about that. The other thing that I mentioned was that Institute of Supply Management, the ISM activity growth, right? So or activity indice, that was another one that I mentioned that I follow. It's one that I include in the slides. So the 2 indices are composite indices based on individual, what we call diffusion indices, measuring suppliers' expectations for the future. So it's the manufacturing index, which is a composite of 5 equally weighted indices: new orders, production, employment, supplier deliveries, and inventories. The non-manufacturing index is a composite index of 4 equally rated indices: business activity, new orders, employment, and supply. So manufacturing, non-manufacturing. Each index is calculated as the share of, respondents who see a positive change from previous months plus 1/2 who are neutral. How do you like that for a calculation? What I'm seeing right now is that we did see a pickup of non-manufacturing. So we actually saw a slight pickup earlier this year, and then it has actually declined again. So when I show the chart, when I'm doing the webinar or the video, when I'm showing the chart, it shows both the manufacturing and the non-manufacturing. And it's just sort of an average line that you'll be able to see. The number above 50 represents economic expansion, while those below 50 suggest contraction. Well, at one point in time earlier this year, we actually saw both of them dip below 50. Non-manufacturing came up, but it has since slid down a little bit. And as of the end of March, it was actually down to 51.2. So, we'll see what happens when the information comes out. The broader economic slowdown can usually really be a good indicator. And if you look at it from 2020 until now, because in 2020, it did significantly dip and then it spiked back up. It stayed there until about the beginning of 2022. And then we've seen, consistently seen it falling. And again, those two indicators to me are indicators that we're probably going to be in a recession or are in a recession. And I can't say for sure, because we won't know that until some of the data comes out, probably not until July, actually. And maybe even after that. I'm just simply saying what I see on the charts and my interpretation of those two particular indicators. So I'm going to leave this podcast short and sweet because I feel like I just threw a lot at you in a very condensed period of time. But just to recap super quick, two indicators that I look at and report on and take into consideration when people ask me if we're in a recession or not are the leading economic indicators and the Institute for Supply Management. We hope you've enjoyed this podcast. We realize this information is relatively dry in nature, but we still want to make sure that you feel educated about some of the terminology that's being used out there. If you turn on the TV and they're throwing all these terms out and you don't really know how it relates to you, we hope you'll re-listen to the podcast. We certainly hope that you'll share this podcast with your friends. Rate us on iTunes so that more people like you can find this information available to educate them. Thank you so much for listening.
And that will about do it for today's episode of Wine and Dime. You can contact Amy through the website, www.rootedpg.com or amy@rootedpg.com. You can also follow us on Facebook and Instagram @rootedpg for the latest news. And if you have any questions, comments, or topics you would like to hear about, feel free to let us know. And don't forget to rate and subscribe the show wherever you get your podcasts. And again, thank you for listening, and be sure to tune in next time.